AI isn't just creating winners, it's quietly destroying entire sectors. Because while chip companies are booming, software firms are facing a hidden threat.
All right, let's get right into it. We're looking at an absolutely unprecedented challenge facing the world's most powerful central bank. And it's not just some abstract economic problem. We're talking about a full-blown political showdown with a very real deadline, and it has some of the biggest investors on the planet battening down the hatches. So before we even touch the politics of this whole thing, let's do what the pros do. Let's follow the money. Not what people are saying on TV, but where the really big, smart money is actually flowing. And right now, their actions are telling a very, very clear story. I mean, just look at this number. $370 billion. That's the record cash pile that Berkshire Hathaway is sitting on right now. You know, Warren Buffett's company, the name you think of when you hear patient, long-term investing. That's nearly 40% of their entire market cap, just sitting in cash and short-term bills while the stock market is hitting record highs. You gotta ask yourself, what do they see that maybe the rest of us are missing? And hey, it is not just Berkshire. For 16 years in a row, the world's central banks, the people who run the global monetary system, have been quietly buying gold. And it's all led to this truly incredible moment we're in right now. For the first time in modern history, the value of their gold reserves is now greater than their holdings of U.S. treasuries. Just let that sink in for a minute. That's a massive, fundamental shift in how the world's financial plumbing works. So what is going on here? What's causing this huge move into defensive positions? Well, it all boils down to a deadline that's fast approaching and a political fight over the future of the Federal Reserve itself, the likes of which we have never seen before. And this whole situation has escalated so quickly. It all kicked off in January with this seemingly bizarre criminal investigation into Fed Chair Jerome Powell over a building renovation, of all things. But then, by March, a federal judge steps in, throws out the subpoenas, and calls the whole thing pretextual. Then things got even weirder in April. You had DOJ prosecutors making unauthorized visits to a Fed construction site, a super contentious confirmation hearing for Powell's potential replacement, and all of this is happening as the clock is ticking down to May 15th. That's the hard stop. That's when Powell's term is officially over. And this, right here, this is where the story really pivots. Because the federal judge didn't just dismiss the case. He went on the record and said there was, and I quote, essentially zero evidence of criminal misconduct. And then he used this incredibly loaded phrase. He called the entire investigation a pressure campaign. Now, that is not legal language, folks. That's a judge basically signaling to everyone that this isn't about the law. It's about political power. And that pressure campaign has created total political gridlock. The nominator on the Fed, Kevin Warsh, is completely stuck. He can't even get a vote because a senator from the president's own party is blocking him. Senator Tillis is basically holding the nomination hostage, saying nothing moves forward until the DOJ drops its investigation. So you've got this total standoff, with the deadline just getting closer and closer. Now, okay, a criminal probe into a sitting Fed chair, that is definitely new territory. But the underlying theme here, intense political pressure being put on the central bank, oh, we have seen that movie before. And history gives us a pretty clear roadmap of what happens next. You can almost think of it as a three-act play that repeats itself. Act 1, politicians force the Fed to keep interest rates low. That's what happened in the late 40s, and it led to crippling 25% inflation. Act 2, the pressure gets so intense that a leader breaks a fundamental rule of the monetary system. Think of President Nixon in '71, leaning on the Fed and then just unilaterally closing the gold window. And that leads to Act 3, years of chaos and runaway inflation that finally force a new, independent leader, like the legendary Paul Volcker, to come in and restore order by hiking interest rates to a brutal 20%. The pattern is always the same: political pressure followed by monetary chaos. So what does that monetary chaos actually look like for an asset? Well, check out what happened to gold, the ultimate safe haven, right after the Nixon shock. In 1971, it was pegged at $35 an ounce. Less than 10 years later, it hit $850. That's a 2,300% gain. And let's be clear, it's not because gold suddenly got more valuable. It's because the US dollar got worth a whole lot less. So the big takeaway from history is really brutal, but it's simple. Every single time we see this kind of intense political interference with the central bank, it's followed by a significant debasement of the currency. Plain and simple, the value of the money in your pocket goes down. And that brutal lesson from history brings us right back to where we started. It explains exactly why Berkshire Hathaway is holding a record pile of cash and why central banks around the world are stocking up on gold. They're not just guessing, they're reading the exact same historical playbook, and they are getting ready for the consequences. And their strategy right now is like a masterclass for any investor. First, they're showing incredible patience and prioritizing liquidity. Holding cash isn't about timing the market, it's about having the dry powder ready when opportunities appear. Second, they're buying monetary insurance, using hard assets like gold as a hedge, almost like a life raft in case the currency system gets rocky. And third, they're practicing prudence at the peak. They're hedging their portfolios even as the market hits new highs. That gap between institutional caution and retail euphoria, that's a classic warning sign. And they're getting this defensive at a time when market risk is already flashing bright red. This right here is the Buffett Indicator. It's just a simple ratio comparing the total value of the stock market to the size of the economy. Right now, it's at 232%. To give you some context, that is the highest reading in 100 years. It's more expensive than the peak of the dot-com bubble. It just means there is very, very little room for error here. And as if those extreme valuations weren't enough, the wider economy is mixing up a pretty nasty stagflation cocktail. You've got GDP growth that's slowing down, but at the same time, inflation is staying stubbornly high. So you have a trifecta of economic weakness, persistent price pressure, and a high-risk, super expensive market, all at once. A leadership crisis at the Fed, the one institution that's supposed to provide stability, is happening at what might be the worst possible moment. So really, it all comes down to this one question that you have to ask yourself. Is this all just another political headline, the usual noise out of DC that will eventually just blow over? Or are the lessons from history, the flashing economic warning signs, and the defensive moves from the world's smartest investors all pointing to a genuine crisis with historic consequences just around the corner? How you answer that question for yourself will probably define what happens to your portfolio in the months and years ahead.
But the real opportunity might be where fear is the highest, not the hype. Subscribe if you want to spot opportunities before the crowd does.